Hello and welcome to 5 Year Club video number 272. Tonight we have an article discussing a decision made by the Texas Public School Pension Fund. And let's get to it. In Texas, teachers see savings eroded by bad bets on exotic stocks. This is from September 28th. And let me move that up a little bit. There we go. Get the ad out of the way. Okay. The teacher retirement system of Texas Board of Trustees at a meeting in August where officials discussed the fund's unsound accounting status, resulting from years of low investment returns. Few people remember the exact events that led some 1.5 million Texas public school teachers to invest a big chunk of their retirement savings in a Turkish steel company now in the crosshairs of President Donald Trump. But it all dates back to a warm, overcast day in February 2007 in the wine country town of Fredericksburg. There, in an airport conference center styled to look like a World War II-style concert hut, Texas officials made the historic decision to pump nearly 10% of the state's biggest public pension fund, the Teacher Retirement System, into stocks from risky places like Brazil, Russia, India, China, Mexico, South Africa, and Turkey. Such emerging market stocks are considered highly speculative even by professional investors because the countries often have authoritarian governments, widespread corruption, fledgling markets, volatile currencies, and more tumultuous economies when compared with markets in the US, Europe, and Japan. The trade-off, at least according to the Teacher Retirement System's then chief investment officer, a former hedge fund executive named Thomas Britt Harris, was that the riskier investments would bring bigger rewards and a bigger payoff for the teachers. It hasn't worked out that way. Over the past decade, emerging market stocks have produced investment returns averaging just 1.1% per year, well below the Texas Fund's overall target of 8% and a fraction of the 11% average return projected by state officials back in 2007. Partly as a result, the fund became actuarially unsound, an accounting designation that means teachers probably will have to increase their required monthly contributions to keep the retirement system solvent. Ironically, had the trustees instead simply kept the money in the Standard & Poor's 500 index of large U.S. stocks, they would have reaped returns averaging 8.9% per year or more than enough to put the pension fund back into a sound footing. Taking that risk was not a good thing, says Stephen Nesbitt, CEO of Marina Del Rey, California-based Cliffwater LLC, which advises pension funds and foundations on investments. In hindsight, anything non-U.S. has been particularly smart. Anything non-U.S. has not been particularly smart. The Teacher Retirement System isn't the only public pension fund that loaded up on emerging market stocks in search of higher returns. Based on a review of public reports, meeting transcripts, and government documents obtained through open record requests, funds in New York, Connecticut, California, and other states also dove in, convinced that rapid economic growth in less developed countries would bring superior returns, and that third world debt crises of prior eras had faded into the past. But the Teacher Retirement System's decision to pump almost 10% of its assets into emerging market stocks amounted to a bold Texas-sized bet. As of March 31st, the fund held about $13.8 billion of emerging market stocks, the highest allocation on a percentage basis among U.S. public retirement plans, according to the publication Pensions and Investments. Even the California Public Employees Retirement System, the nation's largest public pension fund, has kept its allocation to the asset class at a trim 4%. In hindsight, the dismal returns from the emerging market stocks over the past decade show that the Texas Fund strategy was a big mistake, and the portfolio is poised to rack up additional losses this year, with stocks from China and Turkey falling due to major shifts taking place in global markets. A key index of emerging markets is down 12% this year, while the S&P 500 has gained 12%. One key handicap for the Teacher Retirement System is structural. Professional investors can rush in and out of emerging market stocks when the market sentiment shifts, but a giant public bureaucratic fund like the one in Texas, now at $150 billion in assets, can't so easily bob and weave. Shad Rowe, a Dallas-based investor who previously served as chairman of the Texas Pension Review Board, which oversees the state's retirement systems, said in a telephone interview that it boils down to good old Texas common sense. A state-run pension fund set up to invest teachers' retirement savings shouldn't be making big stock bets in risky foreign countries. Corporate standards are higher in the U.S., with strict accounting rules, ample disclosure, prohibitions against conflicts of interest, watchful compensation policies, and vigilance against corruption, Rowe says. What's more, many large U.S. companies already have operations in emerging markets, so investors can get exposure to the countries simply by buying the S&P 500, he says. John Paul Smith, a former Deutsche Bank analyst who correctly predicted Russia's stock market crash in 1998 and now runs his own emerging markets analysis firm in London, says the U.S., Europe, and Japan have capital markets and democratic societies that foster and reward innovative and disruptive companies like Alphabet Incorporated, Amazon.com Incorporated, and Apple Incorporated. The U.S. is the place to be because of the rule of law, Rowe said in a telephone interview. At least you have some chance of succeeding. We cash our checks here. We do business here. What is the excitement of investing in Peru or Colombia? I think it's crazy. Trump's threat to impose steep tariffs on imports from China have prompted many big investors to pull their money out of the Asian country, weakening its currency versus the U.S. dollar. A years-long corruption probe in Brazil has thrown the country's politics into disarray, while Russia is suffering under sanctions stemming from its occupation of Crimea, alleged interference in U.S. elections, and, more recently, the attempted poisoning of an ex-spy in Britain. Mexico has lost some allure in the eyes of pro-business investors for the election of a leftist president last month, in turn partly triggered by an anti-Trump backlash among Hispanic voters. The U.S. Federal Reserve's steady push to raise interest rates has increased yields on U.S. assets like Treasury bonds, making many big investors less keen on putting money into risky foreign countries. As they've brought that capital back to the U.S., the dollar has surged, which by definition means the other countries' currencies have fallen. It's a value killer for investors in foreign stocks. And then there's Turkey, the latest poster child for an emerging market meltdown. The increasingly authoritarian president Recep Tayyip Erdogan, I'm sorry, I can't pronounce that name at all, has condemned rising interest rates, a key monetary policy tool that's typically used to push back against rampant inflation and a tumbling currency. The country's exchange rate and stocks took another hit recently when Trump doubled tariff rates on imported steel from Turkey over the country's detention of American pastor Andrew Brunson. As part of its portfolio of emerging market stocks, the Teacher Retirement System has been a big investor in Erdemir for the past year. This year alone, the company's shares have tumbled about 29% in dollar terms. Rob Maxwell, a spokesman for the Teacher Retirement System, wrote in an email that the goal of investing so much in emerging market stocks was to improve the return of the trust at the same or lower risk. Over the decade through August 2008, he noted the stocks had returned an average 18% per year, and the trust's investment partners expected them to continue to outperform the U.S. market. With the benefit of hindsight, we can see that many were proved wrong in that the U.S. outperformed emerging markets, Maxwell said in an email. The Teacher Retirement System's chief investment officer, Jerry Albright, declined to sit for an interview, according to Maxwell. It's perhaps no coincidence that the Wall Street analysts started touting emerging market stocks in the early 2000s, just after the crash of the high-flying dot-com stocks they had once touted. The theory, promulgated by prestigious firms like Goldman Sachs Group Incorporated, was that less developed countries would post faster economic growth over the coming decades than big modern markets like the United States. Therefore, the stocks were bound to outperform. Investment strategists pushed the idea that money managers should have diversified portfolios in emerging market stocks. The thinking went, would do well when U.S. stocks languished. It didn't hurt that the stocks went on a hot streak in the mid-2000s, making them an easy sell for Wall Street brokers and a popular choice among the consultants who advise pension funds and on their portfolios. Investors were dazzled by the powerhouse growth of China and India and the fast fortunes made by showy tycoons in Brazil and Russia, and the pension fund managers were no exception. In 2007, J.P. Morgan Chase & Company, the giant U.S. bank, told the Teacher Retirement System that the exotic stocks would produce long-term results averaging 11.5% a year, the highest among 25 asset classes, according to documents prepared at the time by the pension fund's staff. The banks, of course, would make fatter commissions from handling exotic international trades than they could make from slinging plain vanilla stocks on the U.S. exchanges. Ask John Graham Jr., a Fredericksburg-based financial advisor, about his tenure as the trustee of the Texas Fund from 2003 through 2009, and he quickly recalls the February 2007 meeting in his hometown, especially where the board had lunch that day at his wife's restaurant, Hondo's on Main. The popular eating spot is known for its Death Burger, a mesquite-grilled half-pound patty of beef smothered in jalapenos, chipotle chilies, and green onions, then served on a toasted sourdough bun with a mustard mayonnaise mix on the side. But in a phone interview, Graham said he barely remembers the deliberations over emerging markets. "That was a long time ago," Graham said. "I have gone on to other things." So, one of the people responsible for it's just like, meh, not my problem. The risks of third world investing have been well known for decades based on the frequent booms and busts in the countries. In fact, according to a research paper from the Massachusetts Institute of Technology in 2001, crises are happening nearly all the time. There was the Mexican tequila crisis in 1994, the Asian financial crisis in 1997, the Russian ruble devaluation in 1998, and multiple debt defaults by Argentina over the past 2 decades. Brazil, Ecuador, Ukraine, Turkey, and Uruguay also suffered economic crises during the late 1990s and early 2000s. But by the early 2000s, those lessons were all but forgotten. In 2001, the head of economics research for Goldman Sachs, Jim O'Neill, coined the acronym BRIC, Brazil, Russia, India, China, for economies projected to grow faster than places like the US, Europe, and Japan. According to the International Monetary Fund, emerging and developing economies now account for about 60% of global economic output, compared with just under half a decade ago. Scores of Wall Street executives and analysts took up the narrative, especially as stock markets soared in China and Brazil. The risk of investing in emerging markets has been falling over the last few years. Mark Mobius, a Franklin Templeton money manager who's considered one of the foremost experts on the topic, told Bloomberg in 2005. The teacher retirement system was set up in 1937 to provide retirement payments to employees of the state's public schools, colleges, and universities. Since then, it has expanded to about 1.5 million members from 38,000. Based on assets under management, it ranks among the 10 biggest public pension funds in the U.S. Full disclosure, this reporter's spouse is a University of Texas employee and thus a participant in the retirement system. Perhaps unsurprisingly, the giant pension plan is a major Wall Street client with assets rivaling those of the world's biggest hedge funds. In the decade through 2006, the Texas Fund has used a conservative mix of domestic stocks, bonds, and cash to produce 9.2% annual returns on average, plenty enough to meet the 8% target. But in the mid-2000s, then Governor Rick Perry, now Trump's energy secretary, decided he wanted a world-class manager who could bring the retirement system into the modern era of investing, with blossoming asset classes like private equity, hedge funds, and yes, emerging markets, says James Lee, a Houston-based investor who served at the time as a trustee and later chairman of the board. Other big pension funds, like those in California and New York, were pushed into sexier investing frontiers, and the Texas Fund didn't want to be left behind. Enter Harris, 60, a former CEO of Bridgewater Associates, the world's biggest hedge fund. In the universe of pension investing, Harris was a superstar, having served as chief of Verizon Communications Plan, overseeing the retirement savings for telephone system workers and other employees of the utility. While at New York-based Verizon, he had a $40 billion-plus pot of money to farm out, allowing him to befriend some of Wall Street's biggest names. He allocated at least $1.2 billion to Bridgewater and meted out more than $2.5 billion to Morgan Stanley, so much that the investment bank even quoted Harris in its annual report for 2003. He's the only pension fund executive on the Federal Reserve Bank of New York's prestigious Investor Advisor Committee on Financial Markets, which also includes hedge fund titans like Bridgewater Chairman Ray Dalio and Paul Tudor Jones, Chief Investment Officer of Tudor Investment Corp. So when the teacher retirement system suddenly had an opening for a new chief investment officer in 2006, Harris shot up to the top of the list ahead of internal candidates. It didn't hurt that he was a Texas native, the son of a public school teacher, and an alumnus of Texas A&M University, Perry's alma mater. Harris stepped into the post in December 2006 and immediately set about making changes and taking bigger risks. He argued that the Texas plan needed to diversify its portfolio. Too much money was parked in U.S. stocks and bonds, according to documents and meeting minutes obtained through requests made under the state's open record laws. In board meetings, Harris argued that the strategy was behind the times and that it would only produce a projected long-term return of 7.6%, hardly enough to meet the pension fund's 8% target. The trustees, given their lack of high finance backgrounds, were ill-equipped to push back. They included 3 school superintendents, a small-town financial advisor, a retired University of Texas power plant operator, a rancher, a Houston-based lawyer, and 2 private investigators. Before we hired Britt Harris, we used to be very involved in making decisions, says Philip Mullins, the power plant operator who has since retired from the board. But when he came on, the board stopped being hands-on. We knew that he was doing something different. So in early 2007, starting with the meeting at the Fredericksburg airport, Harris revealed his plan to shake up the Texas Fund with a new blend of assets that had gone untouched in the past. To a large part because they had been deemed too risky. Harris's team, along with its outside investment consultants from the firm Ion Hewitt Ennis Knupp, created a new asset allocation plan designed to produce a long-term expected return of 8.7%. Key to the plan was sharply reducing the hedge fund's holding of U.S. stocks and bonds and putting about 10% of the portfolio into hedge funds, 10% into private equity, 10% into real estate, and 10% into emerging markets. While each category was risky on a standalone basis, the theory was that lumping them all into the portfolio would diversify the risk while boosting long-term returns. Any investment professional would have told you we needed more exposure to the EM asset class, said Lee. Emerging markets asset class, said Lee. He resigned from his post at the Texas Fund in 2009 after it was reported that he had a judgment against him in Nevada for $110,000 of unpaid gambling debt. Holy shit. Wow. That's kind of creepy. So who is Lee? It's not Britt Harris, clearly. That's somebody else. James Lee, a Houston-based investor who served at the time as a trustee and later chairman of the board. Okay, fair enough. He now runs the Patriot Fund, a mutual fund that steers clear of companies with business ties to Iran, Syria, and Sudan, since they're designated by the U.S. Department of State as sponsors of terrorism. Harris showed the trustees hundreds of pages of documents ranking various asset classes by their projected future returns. He solicited estimates from the biggest names in finance, J.P. Morgan, Goldman Sachs, and the Swiss bank UBS AG, even the now-defunct Wall Street firm Lehman Brothers Holdings. They all put emerging markets at or near the top of the list. The takeaway? By making Harris's recommended changes, the pension fund would easily surpass its 8% target return. Harris also solicited input from Research Affiliates chairman Rob Arnott, a well-known investment strategist and money manager in Newport Beach, California. Arnott projected returns of 7.8% for emerging markets, the highest among 9 rated asset classes, funded documents show. In a phone interview, Arnott said he submitted the projections as a favor to Harris, but he said he would never have recommended that a big public pension fund like the teacher retirement system take such a massive stake in emerging market stocks due to the historically large swings in their value. I was not a bull on emerging markets at the time, he said. My view was that the long-term returns over a 10 to 20-year horizon would probably be okay, but not brilliant for the volatility involved. According to minutes of the board meetings that year, trustees debated the merits and risks of hedge funds, private equity, and real estate, but little discussion was devoted to emerging markets. I remember very little about it, Jarvis Hollingsworth, a Houston-based lawyer who served at the time as chairman of the pension fund's board of trustees, said in a phone interview in 2015. Earlier this year, he started a new term as chairman. So the people made a decision? Oh, I don't remember. Yet even those who back the philosophy of portfolio diversification argue the Texas Fund went overboard. James Hill, who preceded Harris as the fund's chief investment officer before leaving in early 2006 to run Texas Christian University's $1.2 billion endowment, says the magnitude of the emerging markets bet surprised him when he heard about it. In the early 2000s, he had advocated for the teacher retirement system to buy emerging market stocks, but because of the risk, he says he didn't think they should ever represent more than 2 to 3% of total assets. If you look at emerging markets, they giveth and they taketh away, Hill said in a phone interview. The story of growth, and that's where the world's growth is, well, that's true for a period. But just like any story that has a lot of growth, it has a finite life to it. In October 2007, the Texas Pension Fund sold $8.7 billion of U.S. stocks and used about half the proceeds to buy emerging market stocks. The trade was exactly what Harris wanted, but it didn't go as well as planned during the prior month. In September 2007, emerging market stocks had surged 8%. According to a person with knowledge of the matter, some executives inside the pension fund suspected that Wall Street traders were buying in advance of the Texas size order. It was unavoidable, really, since the big state pension funds must operate in the public eye. After all, during public meetings and in easily accessible reports, the teacher retirement system had tipped its plan to buy a giant slug of emerging market stocks, which often are so thinly traded on their local country exchanges that prices can be pushed up or down by a big buyer or seller. The Wall Street firms stood to benefit grandly from handling the big order for foreign stocks. In 2012, teacher retirement system paid an average of 8.3% commission to international brokerage firms. Holy shit. An 8.3% load on your teacher retirement fund, roughly 4 times the rate paid to U.S. firms, according to an annual report that year. For Harris, though, it was a time to celebrate. He had successfully retooled the Texas Fund's portfolio to his liking and ratcheted up the risk. In early 2008, just months before the subprime mortgage crisis nearly led to the collapse of the entire U.S. financial system, Harris hosted a dinner at Fleming's Steakhouse in Austin, attended by Perry, as well as Lehman Brothers CEO Dick Fuld, Morgan Stanley CEO John Mack, and Larry Fink, CEO of BlackRock Incorporated, the world's largest money manager. Under Harris's direction, the teacher retirement system had named the 3 firms, along with JP Morgan, as strategic partners, a program in which each firm would be paid to manage $1 billion of the fund's money in return provide free advice on investment strategy. Britt was holding court, remembers Ronnie Jung, a former executive director of the Texas Fund who attended the dinner. In hindsight, the Texas Fund would have been hard-pressed to more perfectly time the emerging markets peak, as U.S. subprime mortgage defaults mounted in 2008, wiping out more than $1 trillion of the value of mortgage-backed securities that had been sold by Wall Street during the housing boom. Investors did what investors often do when there's crisis. They sold their riskiest assets and bought U.S. treasuries. Those included the emerging market stocks, undermining the premise that non-U.S. assets would help to diversify a portfolio. Even though the crisis had started in the U.S., the MSCI Emerging Markets Index, the asset category's main performance benchmark, plunged 55% in 2008, far exceeding the S&P 500's loss of 38% that year. By August 2009, the teacher retirement system had lost so much money that its unfunded liabilities, obligations minus assets, climbed to almost $40 billion from $3.5 billion 2 years earlier, according to the annual report. Harris was undaunted. According to the minutes of a board meeting that year, he told trustees that emerging market stocks, now even cheaper, were among the best opportunities around the world. He reemphasized the importance of diversification. The minutes show no dissent from trustees, so they let it ride. Harris quit the Texas Pension Fund earlier this year to take another job as chief investment officer for the University of Texas Investment Management Company, also based in Austin. Harris declined to comment through a University of Texas system spokesman, Karen Adler. Yet the teachers are still holding onto the legacy of the emerging market stocks. According to documents obtained through open record requests, the Texas Fund's emerging market stock holdings at the end of 2007 included Bank of China, which has been roughly flat in dollar terms since then, Bumi Resources, an Indonesian miner, which has since fallen 97%, Italian Thai Development, a construction company in Thailand, down 65%, and Petrobras, the Brazilian national oil producer, down 81%. There were some winners, of course. Microstar International, a Taiwanese computer hardware maker, quadrupled during the period. And don't forget Erdemir, the 53-year-old Turkish company that is now part of OYAK Mining Metallurgy Group, the country's largest integrated steel producer. According to an annual report, the parent company is one of Turkey's biggest employers, with 12,000 employees and net sales of $5.1 billion in 2017, on par with medium-sized U.S. companies like video game software maker Electronic Arts and restaurant chain Chipotle. At the end of 2007, the Texas fund owned 865,000 of Erdemers shares, valued at about 1.8 million. The documents show the stock price plunged during the financial crisis of 2008, but it later rebounded, ultimately quintupled from 2009 through 2017. At that point, according to documents, the teacher retirement system sold the majority of its stake, locking in big profits. Earlier this year, the documents show the Texas fund managers tiptoed back in, amassing 2.2 million shares worth about $5 million at the end of June. They've fallen about 50% in dollar terms since then. The Texas fund's foray into emerging markets still puzzles Terry Ellis, a South African-born investor and horse breeder. And horse breeder, who cares about that? Who served as board chairman in the years prior to Harris's arrival. Putting nearly 10% into the asset class is way too much, he argues. Had he remained chairman, he says he would have tried to stop it. It's all sexy until it isn't, Ellis said in a phone interview from his new home in Florida. It's damn risky by definition. Just talk to the people in Argentina and Venezuela. Even if you tempered your word risky and used the word volatile, putting 10% of your assets into one of the most volatile areas you can invest in, to me, just doesn't make sense. Texas accent added by me, even though the guy's from South Africa. All right, so several things about this article. Number one, if you are in a public pension fund, you're not managing that money. And so you can't trust these people to do the right thing. And, and here's a guy who has held some of the top investment jobs in the world, right? He was, CEO of Bridgewater Capital, which is the fourth largest hedge fund, with the billionaire Ray Dalio. I'm sure this guy is really smart, and I'm sure that he had a lot of reasoning behind what he did, and I'm sure that he consulted with a bunch of really smart people from all these banks. And the truth is, the banks just didn't know what was going to happen, and their models didn't work. But they got paid well for it. They got paid 8.2% upfront trading fees, holy shit, to do these transactions. And the whole thing was front run by other people on Wall Street, which is another premium that was paid because of this. And so, I guess, long story short, don't get fancy. Don't knock the VTI, total U.S. market strategy. It ain't bad. The other thing I think is worth noting is that growth does not equal profit. Growth does not equal profit. A country can grow very quickly. The businesses in the country can grow very quickly. But if they reinvest all of the money and they're not paying it out as dividends, then, and that reinvestment oftentimes in capital infrastructure does not result in higher profits in the future. It's a cost. They reinvest in better infrastructure. It's a cost. And that better infrastructure causes them to compete, these companies to compete with one another. And that competition brings prices down, which is good for consumers, doesn't do anything for investors. So you can have a company that is growing very quickly and not producing very much return for its investors, because the profit is not the same thing as growth. So that's something to keep in mind. I hope that this article was interesting. I hope that it gave you a little bit more insight into emerging markets. And have a fabulous evening.